Your Thai spouse inherits everything you own in Thailand completely tax-free. No cap, no conditions, no inheritance tax whatsoever. That sounds like the end of the planning conversation. It isn't, because the moment assets move from your spouse to your children, that unlimited exemption is gone. The clock resets, and a very different set of rules applies. Most expat estate plans here solve the first transfer perfectly and completely ignore the second one. And there is a second problem that has nothing to do with tax at all. If you own Thai land, a house, a plot, anything that is not a condominium, and a foreign national is named as your heir, that person legally cannot hold the title. Not won't, can't. The law does not permit it, which means your carefully drafted will may force a rushed sale at the exact moment your family is least equipped to negotiate one. This video covers both problems: the inheritance tax rates, the gift tax thresholds, the spousal trap, and the foreign land inheritance rules, in plain numbers, for the expat who has real assets in Thailand right now. Let's put actual numbers on this. The inheritance tax threshold in Thailand is 100 million baht per heir per deceased person. Per heir, not per estate. That distinction matters enormously, and we'll come back to it. 100 million baht. At today's exchange rate, that is roughly $2.8 million. For most expats, retirees, digital nomads, even successful entrepreneurs, the inheritance tax itself is not the urgent problem. The estate would have to be extraordinary to breach that line. But here is where the stakes become very real, very quickly. The gift tax threshold is not 100 million baht. It is 20 million baht per year for gifts to your children, grandchildren, parents, or legally married spouse, and just 10 million baht per year for gifts to anyone else: siblings, partners you are not legally married to, friends, non-lineal family. Above those lines, Thailand charges a flat 5% on the excess as a final withholding tax under the personal income tax system. 5% sounds modest. Run the numbers on a real scenario. You send 25 million baht worth of assets to your adult child in London in a single year. 20 million is exempt. The remaining 5 million is taxed at 5%, 250,000 baht. That is roughly £5,600. Not ruinous, but also not zero. And if you do it without knowing the threshold exists, you have just handed the Revenue Department money you did not have to give them. Now scale that up. An expat transferring a portfolio of condominiums worth 80 million baht to an adult child outside Thailand, structured as a gift rather than an inheritance, could face a gift tax bill of 3 million baht, more than $83,000, that a straightforward inheritance, structured correctly, would have avoided entirely. Here is the context. Thailand passed its first ever inheritance tax in 2016. The Inheritance Tax Act BE 2558. Before that date, wealth transferred at death in Thailand was, for practical purposes, untaxed. For the generations of expats who arrived before 2016, the assumption of a death tax-free environment became baked into their financial plans. Many of those plans have never been updated. The rate structure is straightforward. A surviving spouse, 0%, no ceiling. Lineal heirs, children, grandchildren, parents, grandparents, 5% on whatever portion of their inheritance exceeds 100 million baht. Every other heir, siblings, unmarried partners, friends, 10% above the same threshold. The architecture of this system rewards two things: legal marriage and direct bloodlines. Everything else pays double. And here is the planning opportunity buried inside that rate structure. The tax is assessed on the recipient, not the estate. Each individual heir receives their own exemption. A parent with a 250 million baht estate who has 3 children can pass the entire estate, all 250 million baht, completely free of inheritance tax, as long as each child's share stays below 100 million baht. Structured correctly, the inheritance tax threshold is not 100 million baht. It is effectively 300 million baht for a family of 3 children. That is the kind of number that should be in your lawyer's brief before you write your Thai will. Now, the mechanism that most expat estate plans miss completely. The spousal exemption is unlimited. Your Thai spouse inherits your entire estate: condominium, bank accounts, investments, at 0%. Clean, simple. That part works exactly as intended. But your spouse is not the end of the line. At some point, your spouse will also die. And at that point, your children inherit from your spouse, not from you. The 100 million baht exemption applies again, per-heir, but the clock has fully reset. The assets have gone through one complete tax cycle. Any appreciation in the value of those assets between your death and your spouse's death is now inside the estate that your children inherit. If your Tonglaw condominium was worth 8 million baht when you died and is worth 18 million baht when your spouse dies 15 years later, your children inherit an asset that has grown by 10 million baht, entirely inside the Thai tax system. That is not a tax disaster at these numbers. The 100 million threshold gives enormous headroom. But for high net worth expats with multiple properties, significant investment portfolios, or business interests in Thailand, the compounding effect of the two transfer structure over a 15 or 20-year period is where the real planning conversation needs to happen. And then there is the land problem. This one is not about tax at all. Under Thai law, foreign nationals cannot hold title to land. A condominium in a building with less than 49% foreign ownership, yes. Freehold land, no. If a foreign heir, your child in London, your sibling in Sydney, is named as the beneficiary of Thai-situated land in your will, they inherit a legal obligation to dispose of that asset within a statutory period. They cannot simply hold it. They must sell it or transfer it to a Thai national or eligible entity. In a distressed or time-pressured sale, the price achieved is almost never the price the market would offer with proper preparation. A property that would sell for 12 million baht in a managed 6-month campaign might clear 9 million baht in a forced disposal under a statutory deadline. That 3 million baht gap, roughly $84,000, is entirely preventable with the right structure in place before death, not after. So what does the practical response look like? 4 things in order of urgency. First, a Thai will, drafted in Thai, covering only Thai-situated assets, kept entirely separate from your home country will. Your UK or US will does not automatically govern Thai assets. Thai courts apply Thai law to Thai property. Without a Thai will, your estate enters a Thai probate process that can take years and cost significantly more in legal fees than a properly drafted document would have cost up front. Second, a spouse-to-children transfer plan. If your estate is large enough that appreciation over time could create a meaningful tax event at the second transfer, talk to a Thai estate lawyer about structures that can move assets to your children now, within the annual gift tax exemptions, rather than forcing a single large transfer at death. Third, an asset type audit. Know exactly what you own and how you own it. Condominiums, land, leasehold interests, company-held property, and Thai bank accounts all sit in different legal boxes under Thai succession law. One document that maps your assets to their legal treatment is worth more than a dozen planning conversations that assume everything works the same way. Fourth, a gift tax calendar if you are actively transferring assets to family members now. 20 million baht per year to each child, free and clear. 10 million baht per year to anyone else. Those thresholds reset every January. Use them systematically and you can move significant wealth without triggering a single baht of tax. Here is the one thing to take away from this. The spousal exemption in Thailand is genuinely one of the most generous in Southeast Asia. 0%, no ceiling, no conditions beyond a legally registered marriage. Use it. But do not mistake it for a complete plan. It is the first transfer. Your children face a different system at the second transfer, and the gap between those two events is exactly where most expat estates are currently unprotected. You do not need to solve all 4 problems simultaneously. Start with the Thai will. If you have been living here for more than 2 years and you do not have one, that is the single highest leverage hour you can spend with a lawyer this month. Everything else builds from there. For the full Thai inheritance and gift tax rate tables, the legal asset type breakdown, and the step-by-step guide to structuring annual gifts within the Revenue Department's exemption limits, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com or subscribe to this channel so you don't miss what's next.